China holds a button. One press, and they dump $3.2 trillion in US dollar assets onto the market. Treasury bonds, corporate debt, currency reserves. All of it. The dollar collapses. Interest rates explode. The American economy enters freefall. For 20 years, economists have called this the nuclear option, the ultimate financial weapon, the ace up China's sleeve that keeps Washington awake at night. Here's what nobody tells you. China can't press that button. Not won't. Can't. Because the moment they do, they don't just damage their own economy, they completely annihilate it. Faster than they destroy ours. The $3.2 trillion isn't a weapon. It's a trap. And both superpowers are locked inside it with no way out. This is the most sophisticated hostage situation in history. Two superpowers, each holding a gun to the other's head, both knowing that pulling the trigger means mutual destruction. And here's what makes this terrifying. It's not about what might happen, it's about what's already happening right now. Because China knows they're trapped. And they've been quietly trying to escape for the last 15 years. Buying gold. Building alternative payment systems. Shifting their entire economy away from dollar dependence. But the trap is so deep, the exposure's so massive, that escape takes decades. The question isn't whether they'll get out. It's whether the trap collapses before they do. Let me show you exactly how this trap works, why it's inescapable, and what's happening right now as both nations try to navigate their way out without triggering mutual annihilation. Let's start with the numbers. China's official U.S. Treasury holdings, $731 billion. That's as of July 2025, the lowest level since January 2009. China has been quietly selling for years. In July alone, they dumped $25.7 billion, the steepest single-month cut in nearly 2 years. But here's the thing, that $731 billion? That's just what we can see. China also holds $300 to $500 billion in U.S. corporate bonds, $500 to $700 billion in dollar currency reserves, $200 billion in mortgage-backed securities, $1 to $1.5 trillion in U.S. equities through sovereign wealth funds. Add it all up, $3.2 trillion in total dollar exposure. That's more than Japan, more than the UK, more than all of Europe combined. Now, most people hear that number and think, that's China's leverage, that's their power. Wrong. That's their prison. Here's how China ended up trapped. For 40 years, 1980s through 2010s, China ran the largest trade surplus in modern history. They exported everything: electronics, textiles, machinery, toys. The world paid in dollars. Chinese companies received dollars, exchanged them for yuan at Chinese banks. The banks forwarded those dollars to the People's Bank of China. Now, China's central bank has a problem. What do you do with trillions of dollars flooding in every year? You can't just hold cash. Cash loses value to inflation, so they invested it. U.S. Treasury bonds, safest asset in the world, most liquid market, backed by the U.S. government's taxing power. But buying treasuries did something else, something critical. It kept the yuan weak. Every time China bought treasuries, they were selling yuan and buying dollars. This kept the yuan undervalued. Undervalued yuan meant Chinese exports stayed cheap. Cheap exports meant more sales. More sales meant more dollars flowing in. It was a self-reinforcing cycle. The $3.2 trillion isn't separate from China's economic model. It is the economic model. Those dollars represent 40 years of accumulated savings, the entire foundation of their export economy. And that's the first layer of the trap. Okay, let's play out the fantasy scenario. The one politicians and media love to fearmonger about. China presses the button, sells everything. All $731 billion in treasuries hit the market simultaneously. Bond prices collapse. When bond prices fall, yields spike. The 10-year Treasury yield jumps from 4.5% to, let's say, 10%. Here's what happens next. Mortgage rates, which track the 10-year Treasury, hit 13 to 14%. The housing market freezes. Nobody can afford a mortgage at 14%. Home prices collapse. Consumer spending, 70% of the U.S. economy, falls off a cliff. Corporate borrowing becomes impossible at 12 to 15% interest rates. Companies can't refinance debt. Defaults surge. Credit markets, CS. Banks holding treasuries as assets watch their balance sheets implode. Banking crisis. The Federal Reserve is forced to intervene. They print $731 billion to buy the bonds China dumped. Inflation, which they spent years controlling, explodes again. The dollar collapses in foreign exchange markets. Import prices double. Inflation hits 20 to 30% annually. U.S. government borrowing costs explode. Interest payments on the national debt go from $1 trillion per year to $2 trillion. That's more than the defense budget. This is the nightmare scenario. The financial nuclear weapon. Except, wait for it, the moment China dumps those treasuries, China destroys itself even faster. Here's the reality nobody talks about. When China floods the market with $731 billion in treasuries, the dollar collapses. Let's say it loses 30% of its value in a matter of weeks. That sounds catastrophic for America, and it is. But here's the kicker. China still holds $2.5 trillion in other dollar-denominated assets. When the dollar loses 30% of its value, China just lost 30% on $2.5 trillion. That's $750 billion. Gone, evaporated. For context, China's total foreign exchange reserves are $3.34 trillion. A $750 billion loss is 22% of their entire reserve base. That's not a rounding error. That's a solvency crisis. But wait, it gets worse. When the dollar collapses, the yuan surges. If the dollar loses 30%, the yuan gains 43% relative to the dollar. Chinese goods just became 43% more expensive for American buyers overnight. China's export economy, 20% of their GDP, collapses. American consumers can't afford Chinese goods anymore. Chinese factories shut down. Unemployment spikes. But here's the real killer. China's entire financial system runs on dollar liquidity. Chinese banks borrow dollars internationally. Chinese corporations issue dollar-denominated bonds. About $3 trillion in Chinese corporate debt is denominated in dollars. When the yuan surges 43%, that debt just became 43% more expensive to service in real terms. Chinese corporations now owe an additional $1.3 trillion they can't pay. Defaults cascade. Chinese banks holding those corporate bonds face massive losses. Banking crisis in China. The government has to bail out the banks. But they just lost $750 billion on their reserves. They don't have the resources. They print yuan to cover the losses. Inflation in China explodes. And the final nail. China imports almost all its energy oil, natural gas, coal. These are priced in dollars globally. When the dollar collapses, but oil is still priced in dollars, China has to pay more yuan for the same energy. Energy costs double. Manufacturing becomes uncompetitive. The economy grinds down. Let's add it up. China dumps $3.2 trillion. In the process, they lose $750 billion on remaining holdings. Their export economy collapses. Their corporate sector faces a debt crisis. Their banks implode. They're forced to print money. Inflation spikes. Energy costs double. Social unrest begins. All of this happens faster than the damage to the U.S. Why? Because the U.S. has the world's deepest capital markets, the most diversified economy, and the Federal Reserve, which can print dollars to stabilize the system. China has none of these advantages. The yuan isn't a global reserve currency. Nobody wants to hold yuan during a crisis. China's economy depends on exports and external energy. When the dollar trap explodes, China gets destroyed faster than America. This is why the $3.2 trillion isn't a weapon. It's a hostage situation where China is holding themselves hostage. The nuclear option is a gun pointed at their own head. And both sides know it. So if China can't dump the dollars, what are they actually doing? They're trying to escape. Slowly. Over decades. 3 strategies. Strategy number 1. Gold. China has been accumulating gold aggressively. Official reserves, 2,233 tons. But most analysts believe the real number is 5,000 to 6,000 tons. They're not reporting it because they don't want to telegraph their strategy. Strategy number 2. Alternative payment systems. In 2015, China launched CIPS, the Cross-Border Interbank Payment System. It's their alternative to SWIFT, the dollar-based system that handles most global transactions. CIPS processes about $14 trillion annually now. That's still small compared to SWIFT's $150 trillion, but it's growing 30% per year. China has also signed currency swap agreements with 35 countries: Russia, Brazil, Saudi Arabia, UAE, total value, over $500 billion. The goal: create a yuan trade bloc where Chinese imports and exports bypass the dollar entirely. Strategy number 3. Shift to domestic consumption. China is trying to rebalance away from export dependence. They want consumption to rise from 38% of GDP to 60%. It's working slowly. Consumption has risen from 38% in 2010 to 55% in 2025. But here's the problem. All of this takes 20 to 30 years. China's share of global trade settled in yuan has grown from 2% in 2015 to 7% in 2025. At this rate, it'll take 3 decades to hit 50%. And China doesn't have 30 years. Here's why the timeline matters. The US is accumulating debt at $2 trillion per year. National debt is approaching $38 trillion. Interest costs are approaching $1 trillion, annually 14% of total federal spending. The Fed has printed trillions. Inflation persists. The dollar's reserve currency status is eroding, not because China is attacking it, because the US is debasing it from within. The dollar's share of global reserves has fallen from 72% in 2002, about 57% today. If it drops below 50%, confidence breaks. Other countries follow China's lead. This shift accelerates. The critical threshold, 2028 to 2030. At current rates, the dollar hits 50% of global reserves by then. That's when the question changes from, will the dollar remain the reserve currency? To what replaces it? And here's the nightmare. China needs 20 years to escape. The dollar's problem suggests crisis within 5 to 10 years. The math doesn't work. China is trapped in a burning building, and the only exit is a hallway that takes 20 years to walk down. Want to know the crazy part? This trap was created by mutual benefit. For 40 years, 1982-2020, the dollar-China relationship was win-win. China got rapid industrialization. Hundreds of millions lifted from poverty, second largest economy in the world. The US got cheap manufactured goods, $20 toasters and $50 TVs at Walmart. Massive corporate profits from offshoring. Cheap government financing, China recycled dollars into treasuries, keeping US interest rates low. Both sides benefited but the mechanism that created the benefit also created the trap. The interdependence became so deep that neither side can exit without destroying the system. It's two mountain climbers roped together on a cliff face. If one falls, both die. Now, 40 years later, the system is breaking down. China's labor costs are rising. US debt is unsustainable. The benefits are declining. But the trap remains. Both sides want out. Neither can leave without catastrophic cost. Over the next 5 to 10 years, 3 scenarios. Scenario 1, orderly transition, 20% probability. The dollar remains major but not dominant. The world shifts to multipolar currencies: yuan for Asia, euro for Europe, dollar for the Americas. No crisis, just gradual adjustment. This requires competent leadership, stable geopolitics, and no major shocks. Scenario 2, crisis transition, 50% probability. A triggering event: debt ceiling breach, bank failure, geopolitical conflict causes sudden loss of confidence. China is forced to dump dollars defensively. The US retaliates. Mutual destruction plays out. Global financial crisis. Depression. Currency. Chaos. It stabilizes eventually, but only after massive wealth destruction. Scenario 3. The trap collapses on both 30% probability. The dollar's internal problems cause collapse before China escapes. China takes catastrophic losses on $3.2 trillion. Their economy implodes. US economy also implodes from dollar collapse. Both nations enter prolonged crisis simultaneously. No winner, both losers. This isn't about picking sides. US versus China doesn't matter. What matters is this. The two largest economies in the world are locked in a financial structure that benefits neither but traps both. And that structure is unstable. As the dollar weakens, as US debt grows, as China continues trying to escape, the instability increases. You're watching the slow-motion collapse of the financial architecture that defined the last 40 years. And when it fails, however, it fails your savings, your investments, your purchasing power. All of it is denominated in currencies caught in this trap. The dollar will lose value. The yuan will be volatile. The transition will destroy wealth on a scale not seen since the 1930s. The $3.2 trillion trap is the most important financial dynamic in the world right now, and almost nobody's paying attention. Why? Because both governments are pretending it doesn't exist. China doesn't talk about admitting the trap shows weakness. The US doesn't talk about acknowledging. China's leverage creates panic. So both sides stay quiet. Keep executing their slow strategies. And hope they can navigate out before the cliff collapses. But the cliff is crumbling, and the timeline is running out. If this changed how you see the US-China relationship, if you finally understand why neither side can win this standoff, then you're starting to see the real structure of global finance. Not the stories politicians tell. Not the fears media sells. The actual mechanics of the trap. Next video, I'm going to show you exactly what China's buying with the dollars they're quietly moving out of treasuries. It's not just gold. There are 3 other assets they're accumulating that almost nobody's tracking. And understanding what they're buying tells you exactly where smart money thinks value will be. When the dollar trap finally breaks, Subscribe if you want to track how this plays out, because over the next 5 years, this trap will either slowly release or catastrophically collapse. And either way, it's the most important financial story of the decade.